Chief Macro Strategist at Contrarian Macro Advisors is calling for the S&P 500 to hit an all-time high this summer of at least 4,000. But before you shout him down, he's also got some good news, precious metals. Let's take a look at his thesis and dive on in. So David Hunter of Contrarian Macro Advisors, Wall Street veteran with 45 years in the game, believes that the market is set to make a massive melt up to an all-time high on the S&P 500 this summer. Hunter sees our current point in the cycle as the front edge of a massive global deflationary debt bubble. He believes the scenario playing out as a huge secular top caused by excessive creation of liquidity by the Federal Reserve, the fractional reserve banking system, and central banks more widely, which has helped contribute to massive leverage within this system. Thus, we shouldn't confuse the stock market with the economy and the clear macroeconomic weaknesses that are inherent within our system. The extensive recent interventions by the Fed have helped to actually arrest declines and generate some recovery and sent their balance sheet towards $6.5 trillion. Such actions were widely anticipated. Indeed, an article last summer in Seeking Alpha identified that whatever the economy does, the Fed will support asset prices. Now the Fed's intervention to arrest declines in asset prices promotes and actually incentivizes reckless behavior on the back of these implicit or explicit guarantees. In Hunter's eyes, this moral hazard, together with the extreme liquidity, are set to drive forward coming stock market growth. Without question, the Fed has become the dominant force in the financial market. The collapse in the price of oil is likely to see bailouts provided for US shale producers and will likely delay the flood of bankruptcies that are soon set to follow. But the sheer scale by which the Fed has actually increased its balance sheet, not just over the last few weeks, but over the course of the last 12 years, has created a slosh of liquidity. This liquidity is supporting asset prices, and it is for this very reason that Hunter believes that the market rally or melt up that we saw up until the oil price collapse will continue into this summer. He believes semiconductor manufacturers, FANG stocks and mining stocks will lead this charge. Meanwhile, the dollar will weaken and gold and silver will move higher. He anticipates that these metals will attain $2,000 and $26 respectively in the summer as the dollar weakens following the Fed's heavy intervention. David Hunter believes that minor ETFs such as GDX and junior ETF GDXJ will hit $45 and $70 respectively, while he sees oil prices picking up towards $30 to $40. But Hunter anticipates that this V-shaped recovery will only last for a quarter, perhaps 2 quarters at most. Given the Fed has actually excelled in the ability to generate debt faster than they can actually print money, such lofty market heights will be unsustainable, and as dire earnings reports come in, there will be a market collapse. With such leverage built into the system, a complete market panic would be difficult, if not impossible, for the Fed to salvage. The damage has already been done. This crisis has dramatically weakened balance sheets, and earnings for most companies will be decimated. Thereafter, the flood of insolvencies begins in this deflationary debt bubble burst. David Hunter believes that this will result in a bear market of historic proportions as a full debt super cycle completely unwinds, which will give rise to a peak to trough collapse of around 80%. So from 4,000 down to 800 on the S&P 500. Ultimately, it will be caused by the fundamental economic weaknesses that are so apparent within our debt-laden economies, together with financial systems that have become so incredibly complex, with quadrillions of dollars of derivatives being created. This is the final snowflake which causes the complete avalanche. He surmises that while the dollar will fall in the short term, as the bust hits it will super spike, and the Fed will provide far greater intervention than that which we have already seen. but he sees the Fed as helpless in being able to actually fight such a downdraft. Yet they will, and if inflation, as Hunter expects, remains absent, they will have free rein to actually embark upon their course of unlimited quantitative easing. He estimates that the Fed's balance sheet in such a scenario could hit anywhere from $20 to $30 trillion. These numbers would require that the Fed actually will be moving it heavily into the equities market and buying as much as they can. And let's just put those Fed balance sheet numbers in context a moment. This would mean an amount somewhere between 100 and 150% of US GDP, similar to that of the Bank of Japan. Globally, other central banks would be following the same course. Meanwhile, Hunter believes that China will be harder hit given their even greater leverage. Just remember what we've seen previously on this channel, that the dollar is at its highest internationally when the market is at its lowest. We saw this in 2009 and again in the fall in 2016. Remember also that a strong dollar is of course bad news for gold. This is our Kurgan versus McLeod. At this stage, Hunter anticipates a forced liquidation of gold positions from a high of $2,000 plus, which could in Hunter's eyes retest the sort of resistance levels that we saw in March 1450 or so. And whether this is the paper rather than the physical gold price will remain to be seen, but it's not all bad news, as we'll see in just a moment. Perhaps the best way of actually considering this viewpoint is like this wave where the market has rallied back up from an early bottom, but we will soon be drawn or pulled ever higher before the final crash actually takes place. Now, whether the S&P 500 could really rally to 4,000 is of course another question, and I'd love to hear your insights on this. And so the creation of all this liquidity and the prospect of universal basic incomes or other derivatives thereof will create a substantial pent-up inflationary force. Most generations have only ever seen disinflation, that is falling levels of CPI-based inflation, but with the sheer quantity of new credit creation from global central banks and governments, an enormous inflationary force will be baked into this cake, and the authorities will be helpless to actually tighten as the economy unwinds. In Hunter's scenario, a deflationary bust would take place before an inflationary lag suddenly starts picking up in a recovery cycle starting at some point in 2021. This phase of his thesis is enormously positive for precious metals, and Hunter thereafter expects that gold will work its way slowly but surely towards $10,000 an ounce. Meanwhile, silver will hit $300 an ounce. Generally, people like to think in a clear linear fashion, yet markets rarely behave so logically. And with the enormous price distortions that the central bank intervention has actually caused, I was so keen to actually explore Hunter's very contrarian views here. It really would not surprise me if we actually started to retest those highs that were attained not so long ago in February of this year. Thus, a market melt up towards 4,000 or so does seem incredibly extreme. Nevertheless, we'll soon see if Hunter's outlook is actually correct. Now, if you want to know why the Fed needs a gold price of $10,000 or so, check this video out here. Or alternatively, if you want to find out whether or not now is a good time to be buying gold, check this video out here. Please drop me a comment, let me know what you think, hit the like button, hit subscribe, and I look forward to seeing you next time. Bye bye.